John Templeton said that bull markets die on euphoria. So let's go back to Trump's election victory. You had flags being waved everywhere, but here was a guy who was going to cut costs. He was going to cut red tape, all that sort of stuff. There was so much positive stuff. We were going to cut the deficit. Well, what happened? You had euphoria.
Things are changing in global markets. There are noticeable shifts taking place. The world's capital is rotating. As always, many factors are at work, but we might be witnessing a once-in-a-generational shift away from US assets, which have come to dominate global capital allocations in recent times. Global investors are diversifying their portfolios. That is why I was keen to host this episode today. David Seaman of Cygni Asset Management and a seasoned emerging markets investor joins me for a fascinating discussion with Sean Peche, the manager of the Ranmore Global Equity Fund. Sean recounts how he honed his value investing credentials at Orbis after qualifying as an accountant in South Africa and before launching Ranmore in London in 2008. Sean has a first-hand take on how capital flows have shaped equity values and built up today's imbalances. While relative value is not sufficient reason for capital to flow, it is a necessary precondition. Sean says there are now multiple reasons why investors, typically fully loaded in the US market, want to recycle their capital. He talks about how he looks for value, why he has recently moved overweight in the UK, why emerging markets have many developed market characteristics, and why he doesn't need the management of the companies that he invests in. As he says, he can best objectively determine the effectiveness of management by watching what they do, not necessarily by listening to what they say. Sean delivers a masterclass on the principles of value investing combined with an acute sense of how the world is changing and how best to load up on asymmetric risk opportunities that will likely operate in his favour as we confront an unforecastable future. Of course, none of what you're about to hear is any kind of advice, and the opinions expressed are not those of Progressive Equity, but just for your information and entertainment only. Always take advice on your personal financial position before investing a penny of your money in these crazy markets. Now, please enjoy our conversation with the Maverick, Sean Peche.
Brought to you by Progressive Equity.
Can we just start by finding out a bit about you, your journey into investing? How did you get into this game?
Yeah, hi, Jeremy. Hi, David, and thanks for the opportunity. You can tell from my accent, I grew up in South Africa. My father passed away rather suddenly. And so my mum was left with a small nest egg. And the question is, okay, well, what are we going to do with this? And so we had some advisors and they helped us. But that was the start of it, understanding what were unit trusts. We used to call them unit trusts, which are mutual funds. Yep. What's in there and what do these companies do? And so I bought this thing called the JSE Handbook. And that was really the start. And I was very fortunate. I was studying business science and I was doing the accounting angle. And my accounting professor was gentleman Brian Hopkins, and he was very interested in finance and the stock market, and he'd often, liven up the lectures, boring old accounting. He would use live examples with reference to companies in the Johannesburg Stock Exchange and show you real balance sheets and income statements, and it really did spark an interest in that. I used to go and talk to him after lectures, and we'd chat about these things. And then when I'd actually went off to Deloitte, did my articles, it turned out he left and went to Old Mutual Asset Managers and became the head of research there. They were looking to hire some analysts, and I went along and he'd remembered me and he gave me my break. And so that's when I started. And I started in the small companies team, which was quite exciting. And this was in the go-go years of, when it was 97, 98. And we had some IT shares. In fact, the first share I picked was a technology company, and it went up, ninefold or whatever. So I thought I knew, all my work way back when it paid off dividends. I'd found the answer. Okay, little did I know around the corner were emerging market crises and tech bubbles bursting. And at the time, I remember I got sent off to Montgomery Securities. They had a Montgomery Securities growth conference in San Francisco, and there were rock bands. It was quite a thing. So it was an interesting time to get into the markets. I then left and went to Orbis, which is a very well-known and highly respected fund manager based out of Bermuda. And they had an investment team over here in London. And I had the pleasure of working with some incredible people there, including the late Alan Gray and William Gray and Simon Moret. Now, that name might not be familiar, but I tell you what, Simon Moret had a huge influence on my investing career and unbelievably smart. He was a Cambridge graduate. He'd studied in South Africa. And here was this unbelievably smart guy, but unbelievably humble. And he used to say, the future is more unforecastable than you think. That was his thing. The future's unforecastable, okay? And I'm thinking, well, hang on, here's this really clever guy telling me the future's unforecastable. How do we manage that? So I've been really lucky in that through my career, I've worked with amazing people. And when I've worked with them, I always try and say, well, what can I learn from this person? What can I learn from that guy? And so that's really what I've done and try to put that together. And that's how we run the money.
And was it through your working with Seaman and your time at Orbis where you honed your value credentials?
I think having had the experience of early in my career seeing a tech bubble burst was quite informative. And, many young people in the industry today don't have that experience. You can say, well, some things are below price to book of one. And you go, okay, but what is that book? Is it a paper machine? What is that book? Is it cash and investment securities? Or is it an antiquated industrial machine that's not worth anything? Is it intangibles? All that sort of stuff. So Orbis definitely honed my value credentials. And then along the way, obviously, you meet people, you get to read people like James Montier. So I remember reading James Montier when I was at Orbis, The 7 Sins of Fund Management. I don't know if you've read that piece.
No, don't know.
Oh, goodness. I read the thing and thought, this is exactly what I think.
I think the best books, the one where you're halfway through and you're going, damn, I wish I'd written this. This is the book I should have written. They're the best ones.
No, absolutely. His 7 Sins of Fund Management was actually just a document. I think it was when he was at Kleinwort Benson or SocGen, one of those. And it was don't believe too much in forecasts, don't meet management's waste of time, all of those types of things. And it really did resonate with me. And a few years ago, I was invited to do a podcast at the Schroders, the Value Perspective podcast. And at the end, they asked for a book. And I said, well, I actually think that James Montier, The Little Book of Behavioral Investing is a great book. It's not spoken enough about, I don't think, in industry, the sort of psychology behind share price movements and things like that. And so what they then did is got hold of James Montier and invited me to co-host it. So I was rather hoping that in the years since then, James would have another sin of fund management that he discovered. And I was, trying to prompt him to say it was passives, but we didn't get that late.
Okay.
And then guys like Howard Marks, in terms of influencing me, a contrarian. Actually, James written a great book, Value Investing. John Neff, another legend, but from many years ago in the US. And my key takeaway from John Neff is he didn't buy businesses that were unprofitable. So, often value investing, you go and buy unprofitable businesses that you hope are going to turn around. Well, many do. Yes. John Neff didn't buy businesses that are unprofitable. That was my key takeaway. And John Templeton. So in terms of the influences, how did I get into it? It's been a long journey. And I've picked up some key things from people I've read, some key things from people I've worked with, and put that together.
What was behind your decision after your period at Orbis to start your own business at Ranmore, which I think was in 2008?
I mean, I'd love to say we went to this, we had a strategy offsite and we did a detailed business plan. It wasn't. It was a case more of really, there's a lot of money in South Africa. There was exchange control at the time. Because of that, it hadn't attracted the interest of many of the large international players at that time. So it was a case of, well, look, maybe exchange control is going to liberalize. If it does, there'll be quite a lot of money available. Why don't we position ourselves to be there when it does liberalize? Of course, by the time it liberalized, you had the Fundsmiths and Lindsell Train and Schroders and all those big guys were there, and Bailey Gifford, and they'd had good performance. And so I'd go around seeing financial advisors and they go, well, why on earth would I be interested in investing in your fund? I've got the Bailey Gifford fund over here and I've got Fundsmith and all the rest. So it's taken a lot longer to capitalize on that opportunity. And in many ways, I've had a similar success over here in the UK. Now our performance has been really good. And so we are attracting money and we've got a feeder fund. But it's been quite a long journey, certainly a long journey. If you'd asked me Where did I think we'd be after 5 years? I thought we'd probably be bigger than we currently are now after 5 years. But we started in 2008.
So it's a long old haul.
It's a long haul.
I'm surprised that there's not more activity, startup activity in sort of boutique asset management.
When I started in 2008, if you look at the passive assets in passive management, it was less than $1 trillion.
Okay, yeah.
Sure. Where are we now? We're at 12. And
passive is just a killer, isn't it?
So passive has been a real challenge because you go and see potential clients and they go, all right, well, yeah, but you're a value fund and that's not where it is right now. And even if I wasn't interested in value fund, I can invest in this Vanguard product at 20 bips. So it's a real challenge. And I think the other thing that I hadn't really thought about, I should have done, but I was just so keen to get going. I just believed I could do it. And so when I have a discussion like this now, it does dawn on me like, wow, it's taken this many years. But when you head down just doing what we love doing, you don't really notice time going by. Let's say you want to start a fund today. Well, it's going to take you a while to get all the compliance and regulatory approvals. Then where are you going to market? Who's going to market it for you? All those types of issues. What's your competitive edge? All that sort of stuff. Then you need a few years to get a rating from the Morningstars and the Trustnets and those guys, because many of the financial advisors and wealth managers can't invest in you if you don't have a rating of some sort. And if those first 5 years are not good, you're out the game. So what do? I think the way to do it today is to actually, there are lots of subscale funds out there that are struggling. And I think don't start one, go and buy one, go and take over one. Because even if it's got a bad track record that you think you can improve upon, at least it's done the time in terms of the ratings, and at least it's on the platforms, because trying to get on some of the platforms was tricky. One shouldn't underestimate the challenges of starting out, because then you go to early clients and obviously they'll want a discount today. If you want to go there, they'll want a discount on the fees. And of course, everybody loves a great story and everyone's a value investor until you hit a rocky period.
You haven't made life easy for yourself because you've launched a strategy investing globally, picking stocks with a value bias in a period where the prevailing investment backdrop is all about growth and only about the US, seemingly. So you've performed incredibly well against a style headwind.
But you have to do what you believe in. If you go out there, it's a case of, then you are the weather vane that Warren Buffett warns us about. If tech is where it's at and you go, right, well, then I'm going to become a tech fund. But you don't really believe that that's the best way to manage money. Then when tech starts underperforming, it's a bit like, imagine you're a quant analyst and you're working with what's working now. Bloomberg's got this functionality, like factors that work. Well, is it high quality? Is it low quality? Is it dividend yield? There were times through time where you just went for the lowest volatility. And then those stocks did terribly. So my view is, look, if you believe in it, then it doesn't matter. You can withstand the pain because listen, this just makes sense. Everybody, when you go on holiday, you look for a bargain. When you want to buy a car, you look for a bargain. When you're buying a house, you negotiate. Buying stuff on discount makes sense. Paying any price for a great asset doesn't make sense in the long term. It did make sense during times of QE. And so that really made it easier to stick with it. Because I just firmly believed in it. But for me, it wasn't a question of, oh, well, that's not working. What's working? Oh, well, let's do that. Then you're going to be chasing your tail. And I think a lot of fund managers do, you end up in this benchmark thing. Should we be underweight, overweight? Don't really like the position, but it's in the benchmark. What do we do? You're chasing your tail. And we don't chase our tail. We're trying to stay on the front foot. And so we just tell clients, this is what we do. If you think that makes sense, great. We're not going to be up every month. We're not going to outperform every month, every quarter, etc. But don't phone us at the end of the month and go, oh, what happened? Last month you underperformed by 50 bips. We're not going to have a great relationship if you do that. So you need to think that this makes sense. And if you think it makes sense, the way in which you manage money makes sense, fantastic. We'd love to have you on board. If you don't, it's really not a problem.
You've got a 98% active share, which is the difference between the portfolio and the benchmark. So very little overlap with the benchmark. So talk us about how you go about constructing the portfolio.
So we don't worry about the benchmark. We're only going to invest in companies that we think make sense. How do we build the portfolio? Well, we start with bottom up. So we're bottom up investors. And when we've got these screens, we haven't got just one screen, we've got a number of screens that look at different things. And then those ideas that come through that screening process, we then say, okay, what has this company generated in cash in the last 10 years? Let's look at the historic income statement, balance sheet, and cash flow statement. What have they generated in cash? And then what have they done with the cash? Have they paid off debt? Have they paid dividends? Have they bought back stock? Have they made acquisitions? If they made acquisitions, did they buy businesses out of bankruptcy, or did they buy businesses at the top of the cycle? Did they issue lots of shares to share options? Like, why have they bought back stock but the share count hasn't gone down? Oh, well, they've been issuing share options. Okay, next. And so we've got a very disciplined and ruthless way of going through these ideas that come out of the screening process, and we'll just discard them and move on. And if you think about the portfolio construction thing, because I often get asked this question, maybe this is a little bit more of an art than a science. Our starting point is, wouldn't it be great to have 50 stocks of 2% each? And that, again, flies in the face of what many investors have been told in recent years. What you've got to do is you've got to find a few fantastic companies with great management teams, great businesses, and you find these businesses and then you hold them forever. That's what everybody says they do, but most people underperform. So something's not working in that formula. And, there have been times in my life when we've had bigger positions way back when. And I guess it comes back to what Seaman was saying, the future's unforecastable. All right, so how do we manage this risk that, things, and what James Montier says as well, how do we manage this risk? Well, you got to diversify, because it's the way in which you deal with that. And having a big position sounds like an obvious point. Well, what you just put all your money in your best ideas. The problem is, which are your best ideas? And, even if you're a good fund manager, because you're dealing with the future, you're only going to get 60, 65% right, which means you're going to be wrong 40% of the time. So why do you want to hold the ones that you're wrong on? Why do you want to hold those forever? Because maybe they're an AOL, maybe they're a Nokia, maybe they're a BlackBerry. So there's always risk to those. So we didn't say, okay, well, look, 50 stocks, 2% each. Some you'll have a little bit bigger. Some will be a bit smaller because maybe they're less liquid. You're not as sure about them, etc. So that's really the starting point. So you have a bit of a tail. And then some, let's say you've got a food retailer and it's a little less volatile and you think that's an attractive business or whatever. It's got a nice dividend or really, really cheap. You might have a bit more in that. That's how we build the portfolio.
You've spoken about avoiding disasters, avoiding value traps. So I guess there you've got two very important ways. So diversification and being very selective in terms of what you will buy. You hinted at then sell process or sell discipline. Is it the case that ones that survive in the portfolio might stay for longer, but that you'll be quicker to sort of kill an idea if it doesn't work out early doors?
So when we do this analysis, we figured out what the cash flows, and we think, well, this is what we think normal earnings are going to be, and this is what we think a fair price is for those normal earnings, then, you get the target price. And so now you've got a total expected rate of return over the next few years. And part of that is dividend income, because where do you get your return from? You get it from dividends, you get it from earnings growth, and you get it from re-rating. Okay, so part of that will be dividends. And so you want to make sure that this company can cover the dividends, if that's what you're relying on for the bulk of your return. And then obviously earnings growth and re-rating are joined at the hip, because if you don't get earnings growth, chances why would you get a re-rating? But then earnings growth is tricky to forecast, and it's always getting the odds on your side. You want to just sort of say, well, look, we've got to get the odds on our side. So because the future is uncertain. So how do we get the odds on our side? Well, if you buy decent businesses, that skews the odds a little bit. Not saying the best businesses in the world, decent businesses. If you're buying businesses with really robust balance sheets, skews the odds a little bit more on your side. You look at somebody like Anthony Bolton, he said, my worst stocks are always ones with bad balance sheets, bad management, and I think those are the main bad businesses. Bad balance sheets is one of them. So get rid of the ones with bad balance sheets, even if you think you can make 10 times your money, because it's just taking the odds off your side. If you've got a stable or improving outlook, well, maybe that gets the odds a little bit more on your side. If you've got management who on your side, you're not just worrying about giving themselves more share options at every available opportunity, you skew the odds. If you don't pay too much, you skew the odds. And you put all of those things together, and hopefully you get the odds on your side. And that's all you're going to do. But of course, things are going to change. The market's going to change. I mean, amazingly, Google wasn't even around when the tech bubble burst. You look at the top stocks today, there's a great YouTube, and it goes through the largest companies by market cap through the years. And it's one of those ones which sort of, move up and down. And you scroll through that and you see in the late 80s, it's Japanese banks you never even heard of. Imagine if you bought those and held forever. You go look at Warren Buffett's 1977 letters and you see things like Kaiser Aluminium and Interpublic. So he didn't hold those forever. I mean, think about where Berkshire Hathaway came from. Imagine if he hadn't sold his textile businesses. So this idea of buying these great businesses and holding forever sounds so appealing. That's what we have to do. Of course, it is appealing in that you don't have to make many decisions, and decisions are stressful. but the world changes. Look at Nike. That was a great business a couple of years ago. You're down 60% on Nike a couple of years ago. But you could have said this is a great business, or Estee Lauder, great business, or Diageo, great business. You lost 50% of your money. So buying great businesses is not the answer if you pay too much for them.
You hinted at the food business there, so Associated British Foods. Maybe that's an example that we could use. I think, at least on your last newsletter, your largest position. And I think the simplest counter that I could bring to a position in ABF is that it looks like the risk is that it is not allocating capital perhaps to its highest and best use. So given that what you just stated in terms of your process, I think that's interesting to explore.
Half the business is Primark, and half of Primark is the UK Primark, and the rest of Primark is elsewhere. So you've had this conglomerate, and then they've got sugar businesses and animal feed business and, the consumer goods businesses like Jordan's cereals. So what was interesting is when we first bought ABF, actually, it was interesting because the stock had fallen quite a lot. And it was at the time of Liz Truss and the UK, and the prices had gone up and UK retail was in the doldrums and everybody was worried about UK retail. And you had a stock. It had a lower price than 2020 in the pandemic, but yet the shops were open. In the pandemic, the shops were all closed. And you had these inflation scares, and you go, well, okay, yes, the inflation is going to hit some part of their business, but actually they should benefit from the sugar business. I've got management team who do bolt-on deals. You're not going to wake up tomorrow. The Western family have got half the business, and you're going to wake up tomorrow and they've done some stupid deal and overpaid. So I've got that on my side. So what we like to do, David, is we like to say, why do we think the stock is mispriced? What is the reason that we think the market? Now, we don't buy broker research. Okay, so we have to, in many ways, just think about it. But what you can see is that people are worried about the UK economy, and this is a mid-cap, and half the business is tied up by the Western family. So in terms of its weighting in the index at a time when passives are getting the flows, it's not getting a lot of love. But yet I've got a buyback. I'm buying this better than average business, 10 times earnings. I'm getting a 4.5% dividend yield. And actually, yes, UK Primark is struggling, but actually Primark elsewhere in the world is growing. And Primark discounted prices, etc. If the economy is tough, well, maybe you trade down to Primark. So, if you can find a better than average business at a lower than average price with a better than average management team, you're on to a winner. And we think that ABF ticks many of those.
The buyback and the dividend are part of the capital allocation, but it's also where they're spending money within the business in terms of CapEx. What's your analysis of their capital allocation track record on that side of things?
I think it's pretty good. If you're buying back your stock 10 times earnings, effectively investing in a 10% return, they don't get into bidding wars with other industry participants. So they don't overpay for assets. They like the bolt-on deals. So I think it seems to be good. And one of the ways in which you can see how capital allocation has been done, we don't like businesses that have done lots of big acquisitions, because big acquisitions come with lots of risk. You look at something like Bayer taking over Monsanto, disaster. If you just get it wrong, if you do a big acquisition and you take on debt or you overpay or you get into a bidding war or whatever, and it goes wrong, you've just got no margin of safety, you're going to get taken out. We love businesses that are buying businesses out of bankruptcy, adding them, stripping out the cost, that kind of stuff. That's great. So we actually look for management teams who got a value investor mindset. And we think ABF do have that. And one of the ways in which you can see whether that works is return on assets. Is return on assets going up over time? Not return on equity. Prefer return on assets. Sometimes return on equity can be skewed because if a company buys back lots of shares, you're reducing your equity, or you go and take big write-offs of intangibles or whatever. But we prefer return on assets. Seems a little bit cleaner, because if you've got lots of debt, that can skew return on equity, whereas lots of debt's not going to make a difference to return on assets.
Presumably your bottom-up process could involve you, ending up with a portfolio full of European banks, for example. How do you guard against that kind of risk?
Well, we did end up with a whole lot of European banks. And that's been a good place to be, Jeremy. But, we also ended up with a whole lot of Russian stocks. So we lost over 10% in Russia. And we didn't obviously think that Putin would be as crazy enough as he is to have invaded. But we got it wrong. That was in 2022, but we ended 2022 up in absolute terms when the market was down 18%. So what we could have done is said, oh dear, okay, we've lost out on Russia, right? That's it. No more emerging market stocks ever again. But we didn't. And so we said, okay, well, there's always, and this is what you always want to try and find, whenever there's volatility, it creates opportunities. So when Russia invaded Ukraine, what happened? People thought, okay, well, who's next? They're going to take over Ukraine in 3 days, and then they're going to move on to other countries. So Bank of Georgian stock market fell, Kazakhstan stock market fell, and we bought Halik back. Of course, at the other same time, people said we don't want any other emerging markets. So people were selling emerging market funds. Well, that gave us an opportunity in Petrobras. And so taking advantage of those opportunities, trying to find the opportunity in the crisis is what allowed us to capitalize. I mean, the other thing is people were selling European stocks. Natural gas prices going through the roof. People saying, okay, well, we don't want, the German industry is being built on a low natural gas price. So what do we not want? We don't want any German businesses that have natural gas as an input. Oh my goodness, he's got Heidelberg Cement, sell. Again, they sold Heidelberg Cement down quite aggressively. But when you actually drill down into that, you go, well, Heidelberg Cement, yes, it's got some exposure in Germany, but most of the business is outside Germany. And yes, they'd hedged the natural gas price. And so if their competitors hadn't, they were in a better position. So it's trying to find the opportunity. And so we made good money on Heidelberg Cement. It's trying to find the opportunity in the crisis. And I guess, that's what I've tried to do along the way. When we've had a big redemption and we were smaller, it was, okay, well, here's an opportunity to sell my weakest ideas. And so that's, I guess, what we've tried to do. The country risk, it's really interesting because we've got a limitation in our prospectus not to have more than 20% in emerging markets, but it's an emerging market based on where the company is listed. And so it's really just crazy. We're going to change that. But if you think about it, Hong Kong is considered a developed market, but China is considered an emerging market. I mean, David, I'm not going to get into an argument with David over here. We run emerging market funds. But you look at this and you go, but hang on, a lot of the Hong Kong businesses are Chinese businesses. Korea is a developing market or emerging market, but that's in the same bucket as a whole lot of countries, and I'm not going to mention, but countries that really are emerging markets.
Poland, I think, is still considered an emerging market, but I would imagine if it's not already, in a few years' time, on most metrics, it'll be more developed than certainly the UK and probably the most of Western Europe.
And Greece. But, you think of South Korea, you've got LG and Samsung and Kia and Hyundai and all these incredible businesses, and you go, this is supposedly an emerging market? It doesn't really make sense. And then even if they do make the stuff in those markets or they're listed there, then where do they make where they generate their revenue? If Apple generates 20% of its revenue in China, it's generating some of its revenue from emerging markets. So a lot of the branded goods companies, they were all shouting about their emerging market exposure many years ago. So I think it's very hazy. And I think that you just think about these great businesses, and you just go and find the great businesses wherever they're listed.
You caught the recovery that we've seen in China very effectively, and you seem to have caught the recovery that we've seen in continental Europe very effectively. I guess the question is, where's the puck going next?
I'd love to say that I've got an amazing crystal ball. We don't. But what's interesting, we are bottom-up investors, and so we don't stare at this crystal ball trying to decide where do we think the world is going to move. But what's interesting about our approach is that I think it creates asymmetry. So by not taking a macro view, and let me give you an example. People were selling European stocks when Russia invaded Ukraine because of the fears of the European economy. And what does the average person get right if you call macro events? And I'd love to hear David's view on that. But let's just pretend they get 50% macro calls right. When I talk to people about that, they go, I think it's lower than 50%. But let's just give people the benefit of the doubt. By us not taking macro calls, we're also going to get 50% right by default. Let's just think about that. So now what happens is Russia invades Ukraine. People are worried about the future of the European economy. The European stocks sell off, and we buying those stocks at bargain basement prices. Now, if the European economy is in trouble, well, it was in the price. We paid the low prices. If perchance the European economy doesn't fall apart, well, you've got an unbelievable bargain. So you've got lower downside, massive upside. You've got the asymmetry. So by not taking a macro call and taking advantage of those things, effectively positions you for what's not priced in. We happen to think that banks, when we owned European banks, and we still own European banks, we have trimmed them in the last month. So you will have seen a few in our top 10 in the last month and a few more the previous couple of months. But, you won't see any European banks in our top 10 this month when our fact sheet's out.
I suppose to ask the question a different way then, where are the main pockets of risk asymmetry in your investment universe today?
Where is the world invested? The world is invested in the Mag 7, it's invested in passives. Where have the passive flows gone? They've chased historic performance. Historic performance being strong in the US, that's where the passive flows are gone. I mean, we haven't seen the passive flows, massive passive flows out of the S&P 500 and those types of companies yet. So it's not going to be over in a month or two. I think this is going to take a while. Let's just use JP Morgan. Pretend you're a big sovereign wealth fund and you've got a huge position in JP Morgan, which trades $2 billion a day, and you want to redeploy some of those assets because you've got 73% of your assets in the US, in line with the world index. You want to redeploy some of that into Europe and Asia. Well, some of the large banks in Europe, they're lucky if they trade $100 million, $150 million a day. So it's not going to be over in one go. And I think it could be like sheep trying to get out of a Welsh field when the border collies are snapping at the heels. There's some sheep are going to get hurt. And I think emerging markets could be one of those. Definitely. In our top 10 is Shinhan Bank this month. Here you've got a Korean bank, which is retail bank. In the last 10 years, and their shareholders' equity has doubled. The share price is where it was almost back in 2008, I think. And you've got these companies on 5 times earnings and 5% dividend yield, and they're buying back stock. And who's talking about emerging markets? No one really. But in Korea, just on top of that, you had this whole political issue the back end of last year with martial law on, off, all of that sort of stuff. And so those kinds of situations give rise to some opportunities.
I think Jeremy's question may have been his passive-aggressive way of asking why you don't have more invested in the UK. Other than ABF price, I think we could say is probably broadly there for UK stocks. So it's either quality or growth.
We have been buying the UK stocks this month. And I think what we got, just 11, 12% in UK stocks now.
Okay, so you're pretty overweight.
Yeah. So we're overweight. But, when I had this discussion, also I had this discussion with South Africans, they go, why aren't you buying the South African market? It's really cheap. And I go, well, you're not the only cheap market in the world. And there are lots of cheap markets where things are going better for many of the companies. But I think we're overweight. This is the other thing, Jeremy. It's not that far behind the US. So we are very, very underweight the US market. We have some 15, 16% in the US. Okay, when you compare that to 12% in the UK, that's quite a thing. When people tell me, they think the US is very expensive, and I go, well, what percentage have you got in the US? No, I've got 60% of the portfolio in the US.
The market cap of one of the Mag 7 is bigger than the market cap of the DAX 40, just over €1 trillion. If you're a European pension fund, and I believe there's something like 17 trillion of pension fund and other long-term assets invested in the US market, that's 17 German stock markets. I mean, it's not all going to come home. And the price action resulting from that, well, we've seen is enormous, but we're only a few weeks into it.
Well, I think that's right. And I think what's interesting right now, if you think about it, is that for the first time in I don't know how long, international investors have a reason to sell the US and a reason to buy elsewhere in the world, which is other than valuation. Okay, the only argument you could point out in the US in the past is, US is expensive. Everyone would roll their eyeballs and go, but it's always been expensive. But now we've got the disruption from Doge and Trump and alienating allies and. That's the reason to sell the US. Now, but you've got stimulus in Germany, stimulus in China. You've got shareholder governance reforms in Japan, shareholder governance reforms in Korea. You've actually got a reason to buy elsewhere, not just a reason to sell. And I think it could be big. And John Templeton said that bull markets die on euphoria. So let's go back to Trump's election victory. You had flags being waved everywhere, but here was a guy who was going to cut costs. He was going to cut red tape, all that sort of stuff. There was so much positive stuff. We were going to cut the deficit. Well, what happened? You had euphoria. I mean, there was huge money flowed into the US. I think the Mag 7 ETF, one of the Mag 7 ETF, 40% of the inflows came in December. And now here we are, a couple of months into the new year, and NASDAQ's down double digits, S&P's down, the DAX is up double digits, Hong Kong's up double digits. Who would have believed you? Bitcoin Trump was going to be fantastic for all the crypto enthusiasts, and our Bitcoin's down, Tesla's down. Is there further to go? Sure. Nvidia's on 20 times revenue. Not long ago, it was on 1.2 times revenue.
As someone sort of deeply embedded in the UK and subjected to the sort of onslaught of wall-to-wall negativity around, not just from the stock market, but more broadly, how do you see asymmetric risk in the UK?
Well, you've got some really good businesses that are much more attractively priced than elsewhere in the world. I mean, I'll give you one example of a company we're buying this month is Tesco's. Now, Tesco's got, along with many of the other retailers, hit a few weeks ago because of Asda's CEO saying we're going to invest in price. And so the fear is, now Asda's been losing market share, Tesco's been gaining market share, and all of a sudden the fear is, oh my goodness, there's a price war on. And yeah, I mean, there might be, but the food retail industry has changed enormously over recent years because now they derive quite a bit of income from advertising for branded goods companies on their website. They've got all this information via the Tesco's Club card, etc. So if you go onto the Tesco's website and you type in detergent, you will see that a couple of Henkel's products are up at the top of the list and sponsored because they've learned from the Amazons and they've learned from those kind of guys and eBays. This is what you do. You get your supplier and you go to your suppliers and you say, listen, PepsiCo, we're 8% of your global sales. We'd like to be 8% of your global advertising budget. What can you do? And so now you look at these food retailers and they're making substantial money from the advertising and all of that sort of stuff that from the branded goods. That allows them to match the LD and the Lidl on price. So if you don't have that kind of club card technology, it's going to be very hard to match the LD and Lidl on those price points. So here you've got a business which is exceptionally well run at a great price. You know, you look at the likes of Walmart, Costco. I mean, you go buy Costco share today, I think you're paying 50 times earnings. For Walmart, you're paying 30 times earnings. These businesses are barely growing. And Tesco's, you're paying far less than that. So it's another example of a better than average business. And the other thing about food retail is that those businesses make money even in recessions. So who knows what the economic outlook's going to be. But if you've got an economic outlook which is difficult, then you can find some safety in food retail. You know, you're paying 12 times historic earnings and I'm getting a 4% dividend yield. And actually it's a fear that Asda is going to make life difficult for them. It hasn't come to pass. They're not losing market share. It's just a fear.
What do you do all day?
What do I do all day?
Yeah, I noticed that you've mentioned it earlier. I come from a world I no longer inhabit that was involved trying to get fund managers to meet companies. A lot of these people seem to spend their whole working day meeting management.
So most of the day I spend looking at numbers. But also I have the luxury, if you think about it, way back when I started, you didn't have conference call transcripts. If you wanted to hear what a company was saying, you had to wait for the annual report or the interim reports that it's been sanitized by a few lawyers along the way and was in some cases outdated. So the only way you could get more up-to-date information is you had to go around and meet management. But now you've got conference call transcripts for results or conferences or whatever, and so I can read those. So we don't meet management because I don't want to be influenced by management. You know, if you're the CEO of a top company, you've probably sold yourself into that position. You're charismatic, etc. And there's a risk that you get swung by these biases. Then something starts falling apart. And I go, we can't sell this stock because Jeremy's a good guy. I've met him and da, da, da. You know, I don't want those biases. If you're going to overprice a deal, oh, don't worry. We can relax because I met Jeremy and he said the business is really good that they're acquiring and actually they got a really good deal. Well, I'll decide myself. So we don't meet management because I think in many cases you can get the answer to whether management's good by what are they issuing themselves as share options? What are they paying themselves? What's the return on assets and return on equity done since they've been involved? And I can decide that way.
If we could perhaps bring in a bit of discussion about AI here. So there's two aspects in particular that I'm very curious about, Sean. One is the obvious one in terms of how you may be finding investment opportunities or theses that may emerge from thinking about how AI may impact businesses. But also I'm curious about your own process. You've mentioned a few times a team. So you have a team of people that you work with who help you do the work that you need to do to execute the process. How are you finding that you can leverage AI to either be more efficient or more effective? You mentioned transcripts, for example. I've noticed myself, no longer listening real time to as many conference calls because I can digest them at almost infinity times the speed using AI expose. So I'm very curious on both those vectors, how you're viewing AI.
That's absolutely right. If you think back to, you used to listen to a conference call, it'd take you an hour while they waffle through the safe harbor and the congratulations. Blah, blah, blah. Okay, then I started reading transcripts, take me 15 minutes. Then what we did years ago, one of my chaps, Joss Fat, used some software. This was years ago. And you came up with positive phrases, negative phrases, that kind of stuff. And you could put the transcript through there and go, okay, well, if I want to look at consumer staples and they're all in the same valuation, which one do I start with? Well, let's see what the management teams are saying. But now you can use AI to summarize that. So you've gone from having to spend an hour to listen to a conference call transcript to getting a summary in a few minutes. Now, you can miss the nuances, but it does say, oh, hang on, that's interesting. And then I'll dive into that. So that's on the one. When we look at a company and we decide this looks interesting, we go back to the source documents and build a model for the last 10 years from scratch, from the source documents. Well, there's some AI tools that you can get where you upload the financial statements and it'll put the historic financial statements in chronological order for you. And if their disclosures change, the inserts a line and adds the new line item. So, that's time saving. If you're doing a request for proposal, we're using AI for that. So if a potential client comes along and says, well, can you complete this DDQ? We basically got our existing DDQ with a whole lot of other questions that we've historically answered. And we use AI to populate their DDQ using our documents. So it's quite amazing what AI can do. And then also just thinking about business. I did a piece a while ago, a presentation, a year and a bit ago, and I said value investing is a great way to play AI because if you think, what does AI do? It helps you cut costs. So what do you want? You want businesses with very low profit margins and huge cost bases because then AI has got lots of material to work with. And so food retailers is one example. AI is helping cut costs and improve stock control using weather forecasting, things like that. Banks is another way. And you've got the likes of BNP. I think I've got 700 projects on the go using AI to improve fraud detection and open accounts and add signatories and all of that sort of stuff. So that's the next benefit. Is AI going to help improve the profit margins on a luxury handbag business? Probably less so. It can be quite meaningful. Food retailers, I think my numbers were, one of the companies we looked at 2% margins, but waste was 1.5%. So if you can reduce waste by optimizing your inventory using economic order quantity and weather forecasting and all the rest, just a little bit, you move the needle.
Thank you. Very interesting. And thank you for your time. Well done on doing what you've done. I feel like you've got a very interesting future ahead of you with your strategy. I look forward to following your progress and reading your stuff with great interest. And David, thanks for your contributions today. It's been great.
Jeremy, it's been a pleasure. Thank you for your interest. And David, thanks so much for the opportunity to speak to you guys. I hope there's something in there for other people out there.
Thank you.
Brought to you by Progressive Equity.